Go back to where we came from and understand that the global divergence call is where it started in January. Again, we started calling for a slowdown in China, Europe, and emerging markets. That all really started to happen throughout the first quarter. Then, of course, you saw a breakout in global currency volatility in conjunction with the breakout in the US dollar in Q2, and all the equity market volatility globally that's born therein all the way through. The top end of the range for the VIX this morning is 18.28, with big fat implied volatility premiums in both the S&P 500 and in the NASDAQ. China. You know, whether you look at China through the lens of China, which you could see in this chart, is now sufficiently in crash mode, down 21%. But going back to January, it was a globally synchronized recovery, and people were long copper, China, copper, more China. They were long emerging markets, Asia. I mean, that looks pretty bad. So yield spread, this is key. All right, this measurement maps whether or not the Fed is getting too hawkish, too late in the cycle. And that's why we've been asking the question, and really the question when it comes to rotating, and what we're going to talk about in the Q3 macro themes deck, where we're going to rotate to less inflation expectations and much more expectations for inflation to fall in the late part of the third quarter and certainly the fourth quarter.